Imagine you wake up one morning, turn on the news, and the headline says, "Trillions wiped out as stock market crashes overnight." Your stomach drops, your retirement account, your kid's college fund, gone apparently in a single day. But here's a question almost nobody asks when they see a headline like that. Where did all that money actually go? Did it get burned somewhere? Did it just disappear into thin air? Stick with me for the next few minutes because the answer is going to completely change the way you think about every market crash you'll ever live through. Most people assume a crash means wealth gets destroyed. $10 trillion in stock value existed on Monday, and by Friday it's simply gone, vaporized, like it was never real to begin with. That's not what actually happens, not even close. What really happens during a crash isn't destruction, it's a transfer. Money doesn't vanish, it moves. From people who panic to people who don't. And understanding that one distinction is the difference between an investor who recovers stronger and an investor who locks in. A loss they didn't have to take. Welcome to Compound Capital Blueprint, where we explain investing concepts in a simple way. But first of all, a quick disclaimer, this is not financial advice. We're not here to tell you what to buy or sell. We're here to help you understand how this stuff actually works so you can make your own decisions with a clear head. So let's start with something basic. What is a stock actually worth? A share of stock isn't a fixed, unchanging object like a gold bar sitting in a vault. Its value is just an agreement, a price at which one person is willing to sell and another person is willing to buy at this exact moment. Nothing more. Think of it like a house. Say your house was appraised at $400,000 last year. If the housing market slows down and appraisers now say it's worth $350,000, did $50,000 physically vanish from the universe? No. Nobody took anything out of your walls. The number attached to your house simply changed because the agreement of what people are willing to pay changed. The stock market works the same way, just faster and louder. When a company's stock price drops from $100 to $60, no money got destroyed. The price people agree it's worth just moved. And that shift in price is where our story really begins. Let's meet two investors. We'll call them Diana and Marcus. Same starting point, same portfolio, same amount invested. Then the market drops 30% in a matter of weeks. Diana panics. She's checking her phone every hour, watching the number get smaller and smaller, and eventually she can't take it anymore. She sells everything near the bottom, converts it all to cash, and tells herself she'll get back in once things calm down. Marcus does something completely different. He does nothing. He doesn't check his account. He keeps contributing the same amount from his paycheck every 2 weeks, exactly like he did before the crash. Here's the part almost nobody mentions. When Diana sold, someone bought. Her shares didn't disappear, they went to another investor at a discount because Diana was desperate to get out and that buyer wasn't. That buyer was often someone like Marcus or an institution, simply continuing to buy at lower prices because they weren't emotionally rattled by the headline. That's the transfer. Diana's fear became someone else's opportunity. The total value in the market dropped, yes, but the money that left Diana's account didn't evaporate. It moved to whoever was calm enough to be on the other side of that trade. Same crash, same world, completely different outcome depending on one decision: sell in fear or hold with a plan. Now let's add a third character into this story because most people aren't quite as extreme as Diana or Marcus. Let's call her Priya. Priya doesn't panic sell everything, but she does pause her contributions. She tells herself, "I'll just wait until things look safer before I put more money in." That sounds responsible, it sounds cautious. But here's the catch. Safer almost never arrives with a clear signal. By the time the headlines calm down and it finally feels safe again, prices have usually already climbed back up and Priya ends up buying back in at a higher price than where she paused. She didn't lose money the way Diana did, but she quietly gave up the recovery that Marcus captured simply by doing nothing. This is important because most of us aren't Diana, screaming and selling everything. Most of us are Priya, pausing, waiting, hesitating, and that hesitation has a cost too, even if it feels far less dramatic in the moment. Now, this isn't just a nice story about two fictional people. Historical data on major market downturns tells a pretty consistent tale. Research on past crashes, including 2008 and 2020, shows that markets have, over long stretches of time, recovered and gone on to reach new highs. Historical data also shows that investors who stayed invested through downturns generally ended up far ahead of those who sold during the panic and tried to time their way back in. Here's the kicker. Studies on investor behavior consistently find that the average investor underperforms the very funds they're invested in, not because the funds did poorly, but because investors buy high, panic, sell low, and then get back in late, missing the recovery. The market itself isn't usually the problem. The timing decisions humans make around it are. So what's the real takeaway from all of this? The wealth wasn't destroyed by the crash, it was redistributed by panic. And here's something worth sitting with for a second. Historical data on major recoveries shows that a large portion of a market's best days tend to cluster right around its worst days, often within just a few weeks of each other. That means an investor who steps out during the scary part frequently misses the exact days that drive most of the recovery, simply because nobody rings a bell announcing, "The bottom is over, get back in now." The recovery doesn't send an invitation, it just happens quietly while everyone is still nervous. Now let's talk about why Diana panics and Marcus doesn't, because this is really the heart of the whole video. Humans are wired with something called loss aversion. Losing money hurts our brain roughly twice as much as gaining the same amount feels good. So when your portfolio drops 30%, your brain doesn't calmly calculate long-term probabilities. It sounds an alarm. It's the same instinct that made our ancestors run from a rustling bush, just in case it was a predator. That instinct kept humans alive for thousands of years. But in investing, it's almost always the wrong response. The market dropping isn't a predator chasing you. It's more like a fire alarm going off in a room full of people wearing warm jackets. Everyone panics, throws off their jacket, and runs outside into the cold, only to realize 5 minutes later they didn't need to. Your psychology, not the market itself, is usually the bigger risk to your money, and it's not just loss aversion working against you. There's also FOMO, the fear of missing out, which shows up on the other side of the cycle. When prices are rising and everyone around you seems to be getting rich, that same emotional alarm system flips into overdrive in the opposite direction, pushing people to buy aggressively right when prices are already stretched. So the same brain that panics and sells at the bottom is often the one that gets overly excited and buys at the top. It's the same wiring, just pointed in different directions depending on the headline of the week. So let's pull all of this together. A crash doesn't destroy value the way a fire destroys a house. It transfers value from people who sell in fear to people who don't. The total number on your screen shrinks, but the money didn't disappear. It moved to whoever was calm enough to stay or brave enough to buy. That feels completely backwards from how it's usually described in the news. But once you see it this way, market crashes stop looking like disasters and start looking like something else entirely, a test of temperament, dressed up as a financial event. So what do you actually do with this? First, decide your plan while you're calm, not while you're scared. Write down, right now, what you will and won't do if the market drops 20, 30, even 50%. Deciding in advance means that when the panic headline hits, you're just following a plan, not improvising with a racing heart. Second, automate your contributions. If your investing continues automatically every payday, regardless of what the market did yesterday, you remove the moment of decision entirely. You can't panic sell what you've pre-committed to keep buying. Third, limit how often you check your portfolio during volatile periods. Checking daily just feeds the alarm system in your brain more fuel than it needs. Weekly or even monthly is usually more than enough. None of this means every strategy works for everyone. What matters isn't finding the one perfect strategy, it's finding the one you can actually stick to when the headlines get scary. Fourth, if you do feel the urge to check the news during a downturn, try asking yourself one question first. Am I about to make a decision or am I just about to react? If nothing has actually changed about your long-term goals, your time horizon, or your income, then a scary headline by itself usually isn't new information that requires action, it's just noise, dressed up as urgency. And fifth, remind yourself of the story we just walked through. The next time a headline says money was wiped out, picture Diana selling into fear, and picture whoever calmly bought her shares on the other side. Ask yourself honestly which one you'd rather be, and then build your plan today while you're calm, so that future version of you already knows exactly what to do. So next time you see a headline screaming that trillions have been wiped out, remember that money didn't vanish. It just moved to whoever didn't panic. If you found this helpful, hit like, subscribe for more videos like this one, and let me know in the comments. Have you ever sold during a crash and regretted it afterward? I'd genuinely like to hear your story. Thanks for watching. I'll see you in the next one. Bye.